Marko Kolanovic from JPMorgan had a chat on CNBC's Fast Money and shared his thoughts about the future of stocks. He's a bit wary and thinks there could be some bumps in the road. While he's not predicting an immediate crash, he feels that we might be heading towards a recession, especially given the current state of interest rates. What's making him nervous? Even though people still have jobs and are working, he's noticed that Americans are not spending as much. If interest rates keep rising, it might even be harder for folks. He suggests that while stocks have their upsides, there's a potential for more significant drops. Marko also highlighted concerns of the big amounts of money tied in commercial real estate. Specifically, he's keeping an eye on massive companies dubbed the Magnificent Seven. Think Apple, Amazon, Tesla. These companies have been leading the way in the stock market, but they might face challenges if a recession hits. The stock market has been a bit rocky lately. Since September began, the S&P 500 has dropped nearly 6%. Some folks even think it might dip below 3,000, which would be a huge 30% fall from where it is now. Marko isn't alone in his cautious outlook. Albert Edwards from the French bank Société Générale recently pointed out today's markets are acting a lot like they did before the big stock market crash in 1987. In a recent note, he highlighted many signs indicating that we might be heading for a recession soon. Bank of America noted in late September that people are selling off stocks faster than they have at the close of 2022. The latest poll of global fund managers suggests that big investors aren't super negative, but they're not optimistic either. Goldman Sachs and Citigroup have cut their end-of-year projections for the S&P 500 index. Salman Amed from Fidelity International believes that because of the Federal Reserve's current moves, we might feel the pinch next year, especially with big companies refinancing their debts in the coming months. After the pandemic, companies took on a whole lot of debt. With rates going up now, that's going to come back and bite us. Companies might struggle with bigger bills and less money for investments and salaries. And if you look at high stock prices and tight lending conditions, it seems like the market hasn't really factored in the possibility of an economic dip. Don't panic, diversify, and hedge. So while the American economy is doing all right for now, some financial minds are suggesting we buckle up just in case of a potential stock market turbulence. Remember to consult your financial advisor and diversify. Don't put all your wealth into traditional assets. Look into alternative assets, especially precious metals. Gold remains the best hedge against the volatile market, crypto, and even real estate. Gold has remained relatively stable, and an inverse relation against the stock market makes it the best hedge. When your traditional assets go down, you still have gold to back you up. If you want to invest in gold now or simply want to talk to someone rather than watch a bunch of videos, read articles, call us. Our phone number is 877-646-5347. Again, 877-646-5347. It's a no pressure conversation, and all we're going to do is answer your questions, and I'm sure you're going to enjoy the people you talk to. Also, if you just want to check out our website, you can go to noblegoldinvestments.com.